Assalamu alaikum. Guys, welcome all to my YouTube channel CPA Dekow Mohamed. Today I want to talk about the type of taxes in Kenya.
Guys, welcome again. I'm your host, CPA Dekow Mohamed. So the focus today is on type of taxes in Kenya. The first tax I want to start with is income tax. Income tax is levied on individuals, businesses, and organizations based on their income. You can pay an income tax as an individual, as a business or organization. Income tax is levied on all the income. It is not only specific to companies. Now, there are several ways of collecting income tax or forms of income tax. First, I want to begin. What are the forms of income tax or the methods that KRA uses to collect the income tax? The first method that KRA uses to collect taxes is the pay as you earn tax. Pay as you earn tax is a tax deducted directly from employer's salaries by the employer. A tax deducted directly from employees' salaries by the employer. It means it is the employer who deducts that portion. And remember, there is a rate. There is a rate given by KRA. It normally depends because that's why I said here it applies progressively based on the income bracket. It depends with your income, and every financial every year they are normally updated with the Finance Act 20 with the Annual Finance Act. Like in this case, we have the Finance Act 2024 being withdrawn. It means now we are using the pay as you earn tax on 2023. We are using the rate of 2023, whereby the first rate is 10%, then the first part is 10%, then we have 25%, 30%, 32.5, and then 35%. So in simple term, payee is a tax deducted directly from employee salaries by the employer. Then we have the corporate income tax, CIT. This is levied on the profit of companies. It is levied on the profit of companies. For resident, the tax is 30%, and for non-resident, the tax is 37.5. So CIT, this is the annual income tax for the companies, whereby after the end of the financial year, the companies have to pay after the end of the that we now we're in December 2024. After this December 2024, we have then January to June 2025 to file your returns for the 2024. You only file once. And then before you have to file the returns, those financial statements must be audited so that you file your returns. 30% if you are a resident company, that's 7.5 if you are a non-resident. And then we have installment tax. This still under the CIT, which is the corporate income tax. Installment tax is paid quarterly by the businesses based on the estimated annual income tax liability, whereby after every 3 months, every quarter, first quarter, second quarter, third quarter, fourth quarter, after every 3 months, the company pays a sample portion of the total income. Like instead of being one CIT at the end of the year, that might become a worrying event for the organization because they might not have the money to pay all the taxes at the end of the year. That's why they can go for installment. They pay part payment of the taxes, and then after the year has ended, that balance is what they pay at the end of December after the financial year or after the calendar year of the company. So this installment tax is helps to reduce the tax liability, and then it also spreads the tax burden. Then we have the withholding taxes. This withholding taxes is deducted at the source on a specific type of income. Not all incomes are subject to withholding taxes. There are specific income that are subject to withholding taxes. We have dividend, interest, professional fees. Like for professional fees, the withholding tax is 5%. If you are have a client and you're offering professional services, they withhold 5% of that income. And that 5% becomes an advance payment of income tax, whereby when at the end of the year, when you're filing your returns, that 5% is already subtracted from your total tax that you're supposed to pay. So it's an advance payment that for the withholding taxes. Then we have turnover tax. This applies to small businesses with turnover of less than 50 million annually. The current rate is 1.5 of the gross sales, 1.5. But remember, if you're filing for TOT, there's what we call now, we have what we call housing levy, whereby housing levy is also on all the incomes. It is subject to gross income of all the gross income of all the incomes you have. So it means 1.5, when you pay 1.5 of gross sales to TOT, you have to pay also 1.5 to housing levy. Then we have VAT. VAT, value added tax, is an indirect tax charged on the supply of goods and services. We have the standard rate, 16%, we have zero rated, and we have the exempt. Those who are exempt from VAT. And then VAT is a general tax that applies on the value added in principle to all commercial activities involving the production and distribution of goods and the provision of services. VAT does not only apply to goods, also services involving the production and distribution of goods and the provision of services. VAT is a consumption tax. Why? VAT is a consumption tax because it's borne ultimately by the final consumer. It is taxed on personal spending, not a charge on businesses. The charge of business is the income tax and not the VAT. VAT, it is taxed on personal spending. When the Kenyans spend their money on buying equipment or buying even something from supermarkets, from those big companies, when you buy something, that product, that's the amount you are going to spend in purchasing that product, there's a VAT attached to it. So it is ultimately borne by the final consumer and not the business. How is VAT collected? VAT is collected at various stages of the supply chain, whereby we have from the wholesaler, distributor to the consumer. And then it is business, they file monthly VAT returns, and all the VAT return must be remitted on or before 20th following the month of the sales. It is charged on the difference between the output tax, that is the sales, and the input tax, that is the purchases. This is the beauty of VAT. You have to take your sales, then subtract the purchases or that purchase expenses they have used on generation of that sales. Then the difference is being given 16%. But if the sales are less than the purchase, then you are not supposed to pay VAT. It is a VAT refund, or it is balanced carried forward to the next month return. Finally, we have excise duty. It is a duty levied on specific goods and services, usually for consumptions. The example of items subject to excise duty, we have alcohol, tobacco products, petroleum products, telecommunication, sugary and beverages. And how is excise collected? It is collected at the point of the production or importation. Manufacturers and importers are responsible for remitting the excise duty to the tax authority. That is a nutshell of the sum of the taxes we have in Kenya. We talked about the income tax, and then I said there are several ways of collecting income tax, whereby we have the pay as to earn tax, we have the withholding income tax, we have the turnover tax, we have the rental. I forgot to say the rental income tax. We also have rental income, whereby those landlords are supposed to pay 7.5. The current rate is now 7.5 for landlords, whereby they're supposed to remit that 7.5 of the income to KRA. That's for me. Goodbye. See you next time. Thank you for watching.